All right, it's time to get started. Thank you, everyone, for being here. This is a TradeStation webinar focused on futures options. We are highlighting our Futures Plus platform. So let's go ahead and get started. This is installment number 3 of the series. There's a couple of sessions we did in the past where Brandon spoke about future spreads. And I just wanted to share with you the link where those archives are located so that you have it handy. Let me go ahead and just paste it here into the chat. And if you go there, you'll find different carousels. One of them is dedicated to future spreads and options. So make sure you go there and watch those prior webinars that are focused on future spreads. But I think today the main topic is going to be futures options. And I did say earlier that this is installment number 3. So it's part of a series. We're going to have a total of 6 classes dedicated to this topic and highlighting Futures Plus and some of its functionality. So before I pass the microphone over to Brandon, let's go through some disclosures. Just keep in mind that every symbol and idea that we talk about is for educational purposes only. These are not recommendations of TradeStation. Online trading is risky, so we should be aware of the risks. And past historical performance is no guarantee of future results. For additional information, go to www.tradestation.com/important-information. And one thing that I wanted to note is that, even though Brandon is our guest speaker, he's not affiliated with TradeStation, although we appreciate him taking time and explaining some of these concepts to us. So thank you, Brandon, for being here. All right, so I'm just going to stop my share. And Brandon, welcome to class, and the floor is all yours.
All right, thank you very much for having me back. I appreciate it. Let me go ahead and share my desktop. And there we are, share. Go ahead and kick this off. Just a quick intro for me. For those of you who may or may not know me, I've been involved in the market since, I think, 1996 or so. So it's 25 plus years. Yeah, it's been a long time. Anyway, I'm a chartered market technician, which means I've got a lot of education in technical analysis. I've done a lot of studies there. I used to run a hedge fund, a private fund. I was whoops, what happened there? A trader for a brokerage. That's how I got in the industry. I started off as a retail broker, moved to the back office, and I actively trade futures, options, and Forex. And I kind of mix futures and options and do options on futures as well. So I've been teaching trading and investing since 1999. So been there, done that, got the t-shirt. So again, this is not about me. We're going to move on and talk about what this course or this education is all about. So for our agenda, we're going to do kind of an introduction to options on futures. In the previous sessions that we just did, our previous 2 that Jesus gave you the link for already, we talked about futures spread trading, which is a different style of trading futures that offers a little bit different types of risk and managing the risk, as well as a different type of reward. And we're now looking at trading options on futures, again, kind of changing the way that we look at the risk involved in the markets. And, basically we'll talk about what they are, how they are different from equity and index options, and why you might be interested in trading them. And we'll talk about how they work, because obviously you don't want to trade something if you don't know how it works. It's a key thing. So we're going to go into diving into that, understanding how to read the chains, talk about delivery and settlement, how that works, and how the prices move on the underlyings and how it affects the actual contracts that we're going to be trading. So I actually do have open my Futures Plus, and that's what I'll be using. If you want to trade options on futures using TradeStation, you must use TradeStation Futures Plus. So you can go ahead and open that account. There's some requirements for that. I think I have some information on that a little bit later. But basically, like I said, if you have any questions and they're pertaining to what we're talking about right now, go ahead and ask them. If I don't answer them right away, I'll try to answer them before we finish, and we'll do a little Q&A. But basically, options on futures, options are nothing more than contracts. And options on equities are what most people are very used to, if you will. They buy options on SPY, or they buy options on Apple or Tesla. We're just exchanging the underlying and making it a futures contract. That's it. Instead of a stock, we're dealing with a futures contract. But options are contracts, nothing more. A buyer pays a premium and they gain the right to do something. So if they buy a call option, we have the same options, calls and puts. If you buy a call option, you have the right to call away something. In this case, it is simply a futures contract rather than 100 shares of stock. If the seller, if they buy a put, then you have the right to put or sell an underlying contract. That's it. And if you're a seller of an option, it's the same for futures as it is for the equities. If you sell, you receive the premium, that is your potential profit, and you are now obligated to do something if assigned. Well, if you sell a call, you are obligated to sell futures contracts at a set price, the strike price, if assigned. If you sell a put, you are obligated now to buy futures contracts, again, at the strike price, the set price at or before a certain date, if assigned. So, the math and everything's transferable. It's really simple. If you've been trading futures, sorry, not futures, if you've been trading options on equities, the transition into options on futures should be pretty simple because, again, there's not really much of a difference. The math and the strategies are mostly transferable. Not 100%. There are some other things we have to keep in mind, but for the most part, they are almost identical to each other in the way their mechanics. So one of the neat things about options on futures is that you can trade a lot longer than you can with the equities. Equity markets, we know, open at 9:30 a.m. Eastern and they close at 4 p.m. Eastern. Well, when you're trading futures, that is about 22, 23 hours a day, depending on which future you're trading, could be a little less. But basically, the options on futures trade the same hours as the futures themselves. So that's pretty neat that you can go ahead and trade those. And if you need to make adjustments in the middle of the night, or say there's an announcement, earnings, for instance, they happen after the equity markets have closed. If you have an option on equity position, there's not much you can do about it. You're in for the ride, and wherever the markets reopen the next morning, now you have to deal with the aftermath. But when you have an option on a future, that's not the case. The options on futures are tradable nearly 24 hours a day, basically the same hours that are the futures, the underlying contracts are available. And the margins are about the same as far as the span margining. What you'll see is the options have a lower margin requirement. You don't have to spend as much necessarily, but the charts, what they call span margin, is all the same. And futures options may be a little more complex. And with that complexity comes with a little bit more risk. You have to realize that, when you buy an option or sell an option for equities, there's a possibility of you having to buy or sell the stock. Well, the same thing happens with the futures contracts. So futures contracts have two types of delivery, and we'll talk about that as well with the options. You have what is called cash settlement, and you have physical delivery. Well, the same thing happens in the options world, because remember, when you're buying an option on a future, you're simply agreeing to take delivery or sell a futures contract. Well, if that futures contract is physically deliverable and you bought or let's say you sold a put on live cattle, and that put becomes exercised, instead of getting the contract, because remember, you sell the put, it gets put to you if you're assigned, you could potentially end up being on the hook for buying live cattle at the expiration. So you have to be careful with that. There's a lot more to this than to simply, oh, I have to buy some stock. No, you have to buy some oil, or you have to buy some gold, or you have to buy some live cattle or sell that. So you have to be careful of that. Additionally, when it comes to equities, settlement is not typically until after the trade is finished. You get the settlement, figuring out how much you made or lost. In futures trading and futures options, we have daily settlement. The money that you make or lose goes in or out of your account daily. So it's a lot different, and you have to be aware of that, especially when you're dealing with your margins and making sure you have enough coverage for whatever might actually occur in the trade. So here's kind of a comparison chart that I have when it comes to futures options. Again, the underlying is one futures contract. That is kind of a substitution. When you look at the stock and ETF options, you would have 100 shares of stock. Well, again, for a futures option, it's one underlying contract that you have. The exercise style, there's a little bit more freedom, if you will, in a way, because you can choose between trading European style options or American style options. With American style options, if you're not familiar, the buyers can exercise whenever they like. An assignment can occur whenever they want. If you get assigned, you have to deal with it if you are short an option. Well, with the European style, there is no early exercise. The only exercise can happen at the expiration of the options, which means if you are selling options, the European style may be a little bit more attractive to you because you are reducing that assignment risk until the expiration. So you can be in a position, not have to worry about being early assigned. Settlement, I already mentioned, there's delivery of futures contracts. Some of them are just settled by cash. Loser pays the winner. Meanwhile, with the equity markets, if you were to go to settlement and the exercise, if it's in the money, you would get 100 shares or sell 100 shares. The other thing that's really, really different is a multiplier. When we take a look at a quote for an equity market, you simply see whatever it's being quoted at. Let's say it's being quoted as $1.57 for a stock option. That means that if you buy one contract, it's 100 shares, that'd be $157 of premium. Well, the futures don't have a set standard of 100 shares. Every contract in futures is different. For instance, if you take a look at, I think, I'm not sure if it has it in the TradeStation website. It's going to go to futures margins. I know it has margin rates, but I'm not sure if it has the point value showing there. If not, there's plenty of places you can find them. If you're trading futures, you should definitely know the point values. Now it just has the margins there. But for instance, if we were trading crude oil, which I don't have showing right now, but let me bring that up. It's very easy to do. This again is Futures Plus. And actually that popped up right away. Crude oil. That's why I was looking at December crude. So if we take a look at this chart or this option chain, for instance, what we're seeing right now is the strike price. Let me just adjust this a little bit more. There we go. So for instance, if we want to buy an option with a strike price of 67, every contract for crude oil, the future itself is 1,000 barrels. Okay. So when you're looking at a quote, if we wanted to buy a put, since I went there first, right here, if I want to buy the put right now, one contract, it's $2.09 per contract for that put. But that's not the actual premium, 209. No, you multiply it by the point value. So in reality, when I push that buy button, I'm putting in an order to buy at $2,090. That's what the margin is going to be, because that's how much I'm paying for the premium. You multiply whatever number you see in the quote or in the chain by the point value. So if I go over here to NASDAQ, and right now I'm looking at, let's see, the 20,600, because that's the closest strike right now. And if I wanted to call, it says 610.75. So if I lock in that price, 610.75, now that's not actually the premium that I would have to pay. Let me go to calculator here, because I'm not doing that in my head. There we go. So it's 610.75 times 20, because each point in the NASDAQ is 20 bucks. So that contract right now would cost me $12,215. Well, obviously we can adjust certain things. If I wanted to trade something a little less expensive, but still wanted to be involved in the NASDAQ, I can go out to MNQ, and there are options on those as well. Just got to find it. Scroll down a little bit here. As you can see, there's a big list of things you could trade. Probably faster to do it this way. There we go. Almost there. M. Oh boy, still going here. There it is. MNT. Nope, almost. MNQ. And there. MNQ. Now I'll do December and done. And there we are. So now it's the same strike prices as the full-size contract. What's different is the point value. So right now we're at 618. We were at 610, but we're no longer multiplying by 20 bucks. Now we're only multiplying by $2. So if I have 618 0.25 times $2, that's only $1,236. Okay, the other one obviously was $12,000 because we're doing $20 a point. So whatever the point value is, that's what you have to multiply these quotes by to see exactly how much the premium that you have to pay or you would receive will be. And they're all different because the futures are all different. Again, if I bring up a different contract and I bring up, let's see, live cattle, or let's do lean hogs. I went H, so we'll go HE. Now you got $500 per point. And I'll go out to February of next year. There we go. So again, you just multiply these numbers for buying or selling by the point value. That makes sense? So quote multiplier, it's not 100 shares like it is for stocks. Across the board, it's easy on stocks. So it's 100 shares. You just multiply whatever the quote is by 100 shares. No, here we have to do the point value of the futures contract. The tick sizes are also different. You might have noticed that in the quotes, or maybe you didn't, but taking a look at these quotes, they will move in whatever the tick sizes are. Right now on lean hogs, it'll move in 0.025 because those are the tick sizes, 0.025. And that's the way they work. If I were to look at crude oil, those move in penny increments, just like crude oil does. So we have 210 by 213. Yep, just went down 212, 213, 212. So as you can see, it's moving the same way as the underlying. NASDAQ, those move in quarters. Okay, so it's always in quarters, or it's whatever the underlying security happens to be. The tick sizes are the same for options as they are for the underlying. Stocks move in dollars and cents, so do the options. The trading hours, I already mentioned, there's a big difference there. The trading hours are 23 hours a day, 5.5 days a week. These markets open on Sunday evening at as early as 6 p.m. Some are 6 p.m., some are 8 p.m. And they go until there's a small shutdown period, and then they reopen again. So if you wanted to take advantage of after hours trading, I know they're expanding the New York Stock Exchange trading, and they got the NASDAQ already expanded a bit. The problem is the volume is very, very light. And even though there's extensions on the stock market, the futures market, the options market has not expanded. So if you want to trade after hours or maybe protect yourself against a major market shift, right? Tesla comes out and announces earnings, or Apple or some major player announces something bad or good, the market's going to move. Well, you can actually trade the options on futures after those regular trading hours. The other thing that's really nice is your requirements are not the same. As far as pattern day trading, there are no pattern day trading rules applied to futures, nor the futures options. So if you want to day trade with a smaller than $25,000 account, you can definitely do that. Just make sure you have enough capital to handle any kind of exercise or assignment you might have to deal with. And you want to make sure you're understanding the margin requirements as well. But you can day trade to your heart's delight with less than $25,000. So those are basically, and I'm not a tax professional or anything, but the options on futures are treated the same way as the futures are, which are 1256 contracts. They get a different tax treatment. So there's a lot of advantages to that. You get a little bit more freedom with when you can trade, a little bit more advantages taxation wise, and you have daily settlement. So again, I'm just looking at a quote that happens to be natural gas, LNE. And after trading these for a while, you'll start to learn some of the symbols. LNE, I know that's light natural gas, even though E, I don't know where that came from. But, for crude oil, I don't know if you saw, it's LO, the symbol for crude oil. But if you were to type in on the search, you can find whatever it is you're looking for. It's not a big deal. Okay. So when it comes to these quotes, especially on TradeStation Futures Plus, this is pretty simple to see. There's actually two types of options chains on the software. This is the new option chain. So if you were to go in, you'll see what's called widgets. And under my options, I have options chain and options chain new. I don't even bother with the old options chain. I'm just using the new one. I like it. And on that new options chain, you get plenty of information. You have the strike prices in the center. The left-hand side are my calls. The right-hand side are my puts, and you can see it says P. So right now, the way I have my columns set up, and you can adjust these and add and remove columns very easily. Okay, I'll actually go out there and show you. Again, if I bring up my options chain, I opened it by just going to my widgets, options, options chain new. I think Jesus has a video on using Futures Plus in the master, or getting started, I think it is. So you can go ahead and go back and review those as well if you choose. But if I want to adjust some of the columns, it's very simple. One of the things, I don't know if you noticed I did, is I went to right click on the columns at the top, any one of them, it brings up this menu. And I did fit all columns to content and resized them a bit so that way I could see them all properly without having the numbers crunched. And of course, I can always widen individual columns if I need to, change colors, whatever it is you want to do, basically by going to edit columns. And I have things like implied volatility, active volatility, statistical or historic volatility. Do I have any call positions? The delta for the calls, how many people are on the bid quoting, the theoretical value, the actual bid price, the ask, how many people are on the ask side, the strike price, and so on and so forth. There's plenty of different information I can get here. At the put sides, if I want to see some of the other things like theta, gamma, vega, where is it? There it is. I can add those in as well. I can make them bold. I can put them centered in the column. There's all kinds of neat things you can do with this. So there we go. We got the gamma, theta, vegas for the positions. And of course, I can widen these out to get some more room if I choose. Just see it a little bit better. But getting back to the options, it's relatively simple to trade them. I mentioned before that the strategies that you have when it comes to trading the equity options transfer over, and you could do very similar strategies, if not the exact same ones, with the options futures. So for instance, in TradeStation, there's another way of looking at some of these quotes. Okay, right now I've got this, let's see. I'm going to minimize this down. There we are. And under widgets, was it? Nope, wrong one. Options, create up a new one here. I think actually that was the old chain, wasn't it? I think I had the old one up, not the new one. This is the new one right here. I was wondering why I was missing a button there. Let me go out to, let's see, corn. So I'll go down to ZC and look for corn. Just randomly picking one here. And it just takes a little while to scroll down. It's not too bad. There we are. ZC. And I have OZC, which is the corn contract I'm looking for. And you notice if I minimize this, yeah, see, that was the old chain. I forgot. This is the old one. This is the new one. I knew it looked a little off. That's okay. It's easy enough to replace right there. The reason why I did that is I can minimize the December. And what you'll notice here is looking at the chain, it'll show you the contract month, how many days are left till expiration. Actually, I don't think I have my Zoom. No, I don't. It's a shame. I have a tool. Let me see if I can get it real quick. I don't know if I'll be able to. I was trying to enlarge some of the stuff on my screen so you can see it better, but I have it on my other computer and not this one. Let me see, zoom it. Nope, I don't have permission for that. Anyway, it doesn't matter. Let me see, does this work? Nope. Okay. I was just trying something else, don't worry. Anyway, getting back to this, you can notice now, right now I'm in the corn and it's showing me the December, January, February, March contract. So December 24, the rest are 25. If I wanted to, I can add another column here. Let's go to crude oil, for instance. Again, C, actually, let me go to D and then work my way back up. It might be easier. Yeah, there we are, CL. LO, select. And what you'll notice when I go to the crude oil, it should be loading it up. Let me close out the old chain. There we go. And that's weird. It's not showing it. Oh, there it goes. It just took a moment. It's downloading. I know. Yeah, corn, and there's crude. What I can also do now is go to my calendar here, and you'll notice there are additional months available if I choose. And the reason why I did this is on a lot of the physical commodities, you can go way out. I could literally look at December 2034 contracts. Now, I'd probably be the only person looking at those, but you could. So I could add more data if I choose to, and I just shrunk it down. Same thing, if I go back to corn, there it is, OZC. I will hit the little calendar here, and you can see I have plenty more months available all the way to December of 2026. And I'll just bring in a few more just to show something here. Now, those months that I'm selecting are the months of expiration for the contracts, the options contracts. One of the biggest differences we have between trading options on stock and options on futures is options on futures, we have two distinct expirations we have to deal with. Okay, it's not just expirations for the contracts, for the options contract, you also have the underlying futures contract. Anytime a contract is out there that you're trading, you've got to deal with an expiration date. Contracts have to have 5 pieces, always. You have to have a buyer, seller, something being delivered or traded, if you will, compensation for that trade, and an expiration date. You always have to have those 5 things for a contract. Could be for a NFL football player, a baseball player. Okay, that has 5 things: the team, the player, the salary, the services rendered, and an expiration date for the contract. So the same thing here, but we have 2 different contract expirations we have to deal with. One is the options series. So in this case, if we're looking at December, we see that there's December, January 2025, February 25, March, and so on. That's the expiration for that particular option. But there's also the expiration for the underlying future, and the underlying future might have multiple options on it. That's this column right here. You'll notice it says ZC December 24. Well, the December options are traded and delivering the underlying December 2024 futures contract. If we want to trade the Januaries, well, the December contract will be expired. It's no longer available, right? So we can't trade the January contracts for options, calls, and puts on a contract that's already expired. So that is actually going to be using the March contract as its underlying. February also uses the March contract. March also uses the March contract. May cannot use the March contract because that would have been expired already. You notice it skipped one, right? Skipped the April. I don't know if I did too, or if it's just not available. Nope, doesn't look like it's available. Okay, so you can see it skips from March to May. That's fine. There's only certain months available at a time. As the calendar rolls through, additional months may become available. Okay, it's just based on the series and what is normally traded. So right now, we actually have the March contract for the futures of corn. There's 3 different options you could trade on it. You could trade the January, February, or March contracts. Okay. Now, each of these has an expiration date as well. Additionally, not to make it more confusing, but there are, just like we have on equity markets, you now have new types of options. You don't just have the quarterlies or the monthlies, right? Monthly options, most people are aware that they expire on the 3rd Friday of the month. With these newer options, they created things called weeklies. And weekly options, I know it's kind of misnamed because they can expire every day. Well, let's take a look at a different contract here. Let me go out to the NASDAQ. Actually, let's go M. Oh, no. Oh, there we go. Go from the bottom here from O, and I try to find NQ. There we go. NASDAQ NQ futures. There we are. And as you can see, it's showing me 4 months. I can bring in more, not too far out. December 28th, though, I can go pretty far. And again, we have December contract, December, March, March, June, June. Okay, so you got to be aware of the underlying. And on this one, let me see if I have, oops, not that. Notice right here where I go to NQ, there are additional products. This one, the NQ and NQ, happens to be the monthly contract that corresponds with the monthly contract of the futures. So we have December, as I said. But if I go here again and click on Q and E, those are end of month options, or QN1, weekly options expiring in the first week, second week, third week, fourth week. So if you wanted to trade the NASDAQ weekly options, you can click that and load. You can see right now I have week 1, November 24, that expires in 4 days, and that's on the December contract. Or I could trade the December first week expiration, and I can add in additional as well. If I wanted to change this a little bit more, you can add in, I think I have to do them separately. Yeah. Sorry, I had my control key, but I have to have a separate window for each one. So if I want to do week 2, again, I can go NQ, week 2, select, and these are now the week 2 options showing December. I can add more. Oh, actually, no, I can't. It's only letting me show the one right now. But that's the November, and that expires November 8th, the second week of the month, but it's still on the December contract. Okay, sometimes you can add them all together. I thought I might be wrong on that. Same thing when I go back to my horn. There's a Z, C. Scroll through here just a little bit. There we go. And I have corn. That's how you do it right there. You can see I can actually combine some of these together where I can look at different weeks of corn. Sometimes you can get several different series together, but I have ZC, and ZC is showing as the corn options. OCD, that is short dated new crop corn, but then I have week 1, 2, and 3 as well for the different weeklies. So I can put those in and trade the weeklies. It's only showing me the most recent one that's coming up at the time. So I know it gets a little confusing, but you have more choices, if you will, when it comes to your options. You have the expiration for the option itself, those contracts, but you also have to be aware of the expiration of the underlying security. You don't have to do that with equities because they don't expire. They're stocks. But futures do have expiration dates. They are contracts. Literally, we are trading contracts on contracts. That's what it is. But the advantage is that we have much more reduced margin requirements. The problem is we're trading much greater leverage, which can increase our risk. We have to be aware of that and respect that leverage that we're getting. So as you can see right now, when I took this picture, I have, what are we on? Corn, as a matter of fact. November and December were tradable options on the December contract. March has the January and March contracts available. Now you'll notice the picture that I took here is different than my live. When I go back and change this back to corn, ZC, OZC, and maybe it's not too much different. Let me see. November, December, January, March, May. Yeah, the November is gone. January, February, March. And if I go into the dates available, yeah, it's showing May. So what will happen is as the time goes by, certain contracts will start to appear available, and then others may drop off. Obviously, that the November contracts are no longer there because they're no longer available. And you can see that even though it says December, it shows you there's 25 days left till expiration. Those expire November 22nd. So you got to be careful for those expirations. And just keep in mind, you've got expirations of options, you got expirations of contracts. That's a little bit different than what we have when it comes to equities. So I kind of mentioned this already. There's 2 different styles of exercise when it comes to options. And hopefully, if you've been trading options, you're somewhat aware of this, but American style options, you can exercise whenever you'd like, in the money, out of the money, whatever. If you're an option buyer, you can go ahead and exercise your rights whenever you'd like, including the day of expiration. If you are a seller of options, you assume that risk because you could be assigned at any time. Well, with the European style options, they're a little more restrictive. You can only exercise at expiration. So the sellers have a little bit more protection there, and it's going to be accounted for in the price as well. If you were to compare kind of side-by-side options, the risk is lower for the seller if they do not have that early exercise or assignment possible on the European style, so there may not be quite as high of a premium collected. Anytime you're taking away risk, you take away profits as well. I'm not saying they should only trade American or only trade European. Some you don't have a choice. If you want to trade a certain type of security, you got to take what it is. But others, you might have a choice. It's a personal preference. Now, one of the things that makes it a little bit easier to trade these is the contract directory and calendar tool. And this is something by the CME group. And I think I forgot to link this, didn't I? Yeah. All right. It's not hard to find. If you're to go to the CME website or even just do a search, CME group, you can search on their website as well. There's a whole host of tools available for options trading called Quick Strike. And if you're just looking for the one, we can just type in contract directory. And it should take me to a link for that. There it is, contract directory and calendar tool. And there's even a little piece on understanding it. And what I can do for you here, actually, there's links to this I'll show you where it is. There's also good information on this as well to help you out. If you go to TradeStation.com, options education, you can scroll down here a little bit. And a second. Go down to explore option strategies. And there you go. Unlocking futures options, a guide to pricing and trading. We have a section on education on that as well. And there should be a link to this as well for that particular page. I know it was there it is. Contract directory and calendar tool. So there's a link right there that you can go to inside the education. And it takes you the exact same place that I just was. Now, what do we care about this? This will give you information about trading the underlying security. Remember, I was talking about the point values. And if you weren't sure what the point values are, you can find it right here. For instance, it defaults to energy. Let's go to nat gas. And you can even see, let me go back one step here. And I'll zoom in a little on this page. There we go. Notice it shows LN, nat gas, LNNG, crude oil, LO, CL. Well, if you trade futures, you know CL is the crude oil symbol. However, LO, you now know, is the option symbol for crude oil. Not the weeklies, but the actual monthlies. Heating oil, HO for heating oil, or OH for the options on heating oil. OB for gasoline, RB is the actual futures contract. So going over to the equities, same thing. They're pretty much the same. The Russell, however, is different. RTY is the Russell futures. RTO are the options on those futures. So you can get the symbols right there by looking at this contract directory and calendar tool. So I'll go back. It doesn't matter which one, actually. I'll go back to nat gas and click on it. And right now it's showing me a monthly calendar. And guess what? These are the weekly options right there. This is October, current date, 29th. I can go to next month, November, and notice we have options expiring every single week. However, there are certain other options available as well. And when you click on them, they will tell you more about what that option happens to be. So for instance, LNEZ4, and what type of option is it? European style. Look at that, exercise style. European. What is it you're trading? How many days left? When does it actually expire? And right there is your point value. Remember I said, in order to figure out the premiums that you are going to be looking at. So for instance, if I go back, I was on the right page. If I go back to my Futures Plus, I don't have nat gas. I have the QN. That's fine. I can use that one. So we're looking at a quote here. Nope, that's the NASDAQ. Let me go to nat gas. NG, there it is. LNE. And now I have my nat gas quote popping up in just a moment. Get rid of this tab. Oh, not rename, sorry. Cancel. Here it is, LNE. That's fine. I don't need to waste time on that. So again, I've got my quotes right here. I'll fit all my columns to edit. And we're currently trading. Here we go. Populating. So let's say I want to trade this, and I'm looking right now at the 4.2 calls. Well, right there showing 0.103. If I want to know what premium that is, remember, I take the quote that I'm getting, 0.103, and I have to multiply it by the point value. What did I do there? It's 203. Well, that point value, that's on the right spot, is in that contract and directory tool. Right there. Quantity, UOM quantity, 10,000. So now I know by going back to my calculator, I just multiply that by 10,000, and it's 1,030 for that contract. That's pretty cool. I can see all that information. I can see termination rules, how trading works, what hours they're traded. Remember what I said, it goes from 6 p.m. Eastern, and they even show you Eastern, 6 p.m. to 5 p.m. or 5 p.m. Central Time with a 60-minute break every single day between 5 p.m. and 6 p.m. Eastern. So when can I start trading this? I can start trading this on Sunday at 6 p.m. That's when it's available. When do I have to stop? 5 p.m. on Monday afternoon, and then it shuts down. It reopens again 6 p.m. Monday afternoon. Then it shuts down 5 p.m. on Tuesday. Reopens again 6 p.m. on Tuesday. Keeps trading until Friday when it closes. So if I want to take a look at something else, or if I want more information on the futures contract, I've got that here too. Look, I can go to the future, and it gives me information on the futures contract. And this is a deliverable contract. What does that mean? That means if I hold this particular security, first of all, European style, it cannot be assigned early. But if I get the option, well, actually, this one is not going to get the option or the futures contract. The option's expiration is financially settled. Futures, if you were to trade a futures contract on nat gas, at the end of that contract, you could get delivery of the natural gas. However, with the option, it differs. This one happens to be financially settled, meaning cash settled. At the expiration, if you are still holding an option that's in the money, the settlement will occur and you will get paid the amount that you are in the money. Or if you are out of the money, then you may have to pay, if you are the loser on that trade, the amount that you are out of the money. That would be your loss. Some of these are physically settled, meaning if they're physically settled, you would get the underlying futures contract. Now, there is one exception to this. If you trade an option, let's see, does this expire same as, no, this is November. Let's go to December. Okay, and I'm on nat gas. If you trade an option that expires the same day as the underlying security, it's probably easier if I do this with the NASDAQ or ES, doesn't matter which one. So right here, the ES, December, okay, notice right there it shows you EW3, that's the third week option, week 1, 2, 3. And notice what else they have. They have options expiring almost every single day. Remember I said there's more weekly options. They expire every day on some contracts, even though they still call them weeklies. But this is what I want to focus on real quick. This is ESZ4, which is the actual futures contract that expires on that day. Now, if we click on the option symbol right above it, you can see this is the option, not the futures. Notice if I click on the ESZ, Actually, this is showing the options on the future. There's a third week, and then there's the normal monthly options. They are American style, okay? And they expire the same day as the futures contract, same time. When that happens, you cannot get delivery of the underlying security. In this case, the futures contract, right? Because notice, normally, if you're in the money at the expiration of these contracts, you get the actual contract from the futures. So if I trade the options on the ES, let's say I buy a call and I'm in the money at the expiration, normally I would receive a long position in the underlying futures contract. In our future sessions, we're going to go more in depth with this with some strategies as well and kind of show you how this works. Okay, this is just kind of an overview of learning about what these are and how they work. But we'll actually see more practical application in the next session. So if you have expiration of both your option and the underlying future, they're not going to give you a contract that's expired. So instead, that becomes cash settled. So even if it's normally a deliverable option contract, and deliverable means you normally are given the futures contract or you are asked to sell the futures contract. Again, if you buy a call or put or sell a call or put, instead, if both are expiring on the same day, those options become cash settled, period. That's it. Because there's going to be nothing to exchange with the futures expire. And a lot of that information, as I said, when these are expiring, how much the point values are, going back to the ES here, what's the point value? Well, right there, $50. So if I go to the ES quote, again, I was on the right page. I have that open still? No. I can change one of these tabs or read or open one. Doesn't matter. I'll just go ES. Just gonna scroll up a bit. There we are. 85. Come on. There's so many different contracts out there. By the way, when I'm going to these columns, I click on the letter that I'm looking for. So I clicked on F to get me to the bottom of the list for the E's. You just scroll through until you find it using the mouse wheel. The N, there it is, ES. And again, just go back down to ES. And there I am. It should be loading up. Just a moment. There it is. Oops. Those are way out strikes. Where am I here? There we go. Minimize and maximize. There we go. I can see the current price right now, as well as these are at the money strikes. So if I wanted to buy a call at the money, right now it's showing 130. But again, it's not $130. It's 130 times $50 because it's 50 per point. $6,500 for that contract. And that's going to be cheaper than trying to hold the futures contract overnight typically as well. Okay, so that's the premium you would have to pay for that particular contract. This is the December contract. It has 53 days left till expiration. So again, going back to the calendar directory and calendar tool, plenty of information there. As I mentioned before, this is actually part of a bigger suite of tools. And right here, so it says more quick strike tools. You can see there's actually quite a bit there if you're interested in using it. You got different calendar calculators, strategy simulators. So you can actually use some of these other tools absolutely free. Some of them are paid, but for the most part, this is the simple tool just to find out more about what it is you're trading and how much that trade is going to cost for the margin deposit based on the quote. You just simply multiply whatever that quote is by the point value for the future. And you find that by looking at that contract. Now, again, if I go to different contract, you go to Forex. And if I want to trade the Aussie dollar, here we go. And now I'm looking at December contract. And I can look to see, okay, well, we have ADZU or ADU, sorry. That's the monthly option. That actually expires on December 6th. It is European style. And now my point is 100,000. So if I want to trade the Australian monthly, it's based on the underlying futures contract, which is deliverable, but it's not going to be deliverable when we deal with it expiring on the same day as the option and the future. But I would just multiply whatever I see on my chart, or not my chart, my chain. Again, just bring up a new chain. CME, AD. If I can find that one quickly. There we are. No, that's not it. Oh, it was probably under. Let's see if it's under 6A. There it is, 6A. Or the Aussie. And there it is, premium quoted European style options on Australian dollar. And when I bring up the quote, what do we have available? We have December contracts right there, so I can look at those. And 0.6550, that's the strike price. If I wanted to buy a call, it is 0.01020. Again, I would just multiply that by the point value. So 0.0102 times 100,000. And that's 1,020 for that contract. That's the premium, 1,020. I click on that buy, that's what it would be. So again, just reading the prices, stock options would be multiplied by 100. Those are simple. But price on the options chain is based on the multiplier for the futures contract, whatever that may be. You would just multiply it by it. So for the NASDAQ, as I show you here, we got a quote 654.25. We have to multiply that by the NASDAQ multiplier, which is $20 per point. And it's a $13,000 contract. Now, when it comes to the settlement, I kind of mentioned this as well. We have deliverable, which means that if you have an option that's deliverable, not the futures contract itself, but just the option, if it's deliverable, if you are a buyer of a call, you can become long the futures contract. The seller will become short. If you're to buy a put, it would be the opposite. If you buy a put and you exercise, then you would become short the futures contract. Basically, if the options are cash settled, though, there is no delivery or receipt of the underlying contracts. You just simply get paid. It's kind of like index options. Equity options, if you are assigned or you exercise, you typically trade the 100 shares of the underlying security. Well, you would trade the underlying contract of futures for crude oil or gold or whatever it may be. However, index options are cash settled. Same thing with many of the options that we're trading here under the contract expiration. This is deliverable for the Aussie, but if I switch to a different product, you saw with nat gas, I'm not sure about crypto, that's deliverable or not. We can check that out. And we have micro Bitcoin or regular Bitcoin. But if I go to BTC Z24, that's European style, that is deliverable. That means you can't exercise early, only at expiration. But if you're in the money, there will be a delivery of the underlying futures contract, except if you're trading the one that expires on the same day. Notice if I click on the future, that expires 12/27 at 11 a.m. If I click on the option, that also expires the same day and time. That would be cash settled. So deliverable options become cash settled if they expire on the same day as the underlying futures contract. Okay. Like I said, we're going to continue on with this discussion in our next session to kind of talk about walking through the different strategies and seeing how they actually work and how trading works. So just as a quick example right here for cash settlement, if you had a 2.850 call option on nat gas, the actual security was trading at 3.8 or 08. That expired in the money. So if you own that option, your settlement price happened to be at 0.351. Now remember, they're buying a 2.850 strike price and they bought it for 0.244. If the settlement price happens to be 0.351, they obviously made a profit. Well, if it's cash settled, the difference right here, you're in the money from 2.850, it moved up to 3.08. So you would receive the difference that you are in the money. Well, remember, you had to pay for this option. So the difference in the initial cost was 24.40, and you received 1,070 profit. So the rate of return in that case was 43.9%. Pretty good rate of return there. So that would be your profit, is the difference between where you got in, the strike price that is, and the actual settlement price for that security. If you have an out of the money option, unfortunately, that just expires worthless and you just lose your deposit, or not deposit, lose what you paid for the premium. So as I mentioned before, trading at TradeStation is a little different when you're dealing with options. They're not subject to day trading requirements. For pattern day trading, you can trade more than 3 in a 5-day rolling period, so you don't have to worry about that. However, margin requirements still are applicable. In order to open an account using Futures Plus, you have to have a futures account with at least $5,000 equity balance. Okay. And instead of trading the options on futures through the normal TradeStation, actually, it's pretty easy to get to the program. This Futures Plus is a web-based program. All you do is go into TradeStation, click your sign in, and right there, Futures Plus login, once you have your approved account, that is. And it's a web-based platform. There's also a mobile version as well, which is kind of nice. So you can access it through your mobile app as well as through the desktop app or web browser. There are no platform fees for the TradeStation Futures Plus, but you still have to pay, obviously, commissions, regulatory fees, and transactions. There may be transaction fees you have to pay. There's regulatory fees and exchange fees as well on most products, especially in the futures market. So we're going to talk, like I said, a little bit more about how we trade those in our next session. I just wanted to kind of go over what they are and how to read some of the quotes. But we can do directional trading just as you would with the equity options. If you're bullish or bearish, you would trade in that direction. You could buy calls, buy puts. You could trade vertical spreads. As a matter of fact, they make it a little bit easier to trade some of those when you go into the TradeStation Futures Plus, because there are right here some already created templates, if you will. And there's also additional tools. Now, some of them do not work in the simulated mode, but if I go to widgets, options, is that the one I was looking at? Strategy creation, there it is. You can actually create individual strategies, and there are templates already preset. Butterflies, call spread versus put, condors, double diagonals, or diagonal counter spreads, covered call. That's the poor man covers call, using basically a diagonal call counter spread. So there's a lot of different trading that's out there. And again, we're going to go through a lot more of this in detail. There's actually several pages of these. You have guts, horizontal strategies, iron butterfly, iron condor, jelly rolls, ratio spreads, straddles. And all you have to do is decide what it is you want to trade, and it'll help you fill in the position to take it. It's pretty neat. Another thing that these are used for is hedging. I mentioned before, just suppose you have a 401k and you're worried about a big announcement after the market closes or the election coming up. You could use the options on futures. If you trade options on stock, you are not necessarily prepared if something happens after hours. If they announce something happening with the election, there could be a jump either up or down in the equities market. If you have options on futures, you could actually hedge a portfolio, and you can react and make adjustments while the markets are open, which for the futures markets and futures options is almost 24 hours a day. So that's pretty neat. And there are neutral market trades that you can do. You can actually trade time decay and volatility the same way you can with the underlying options on equities. So there's a lot of different things that we're going to kind of explore going forward. Like I said, this is just the simple introduction, excuse me, to trading options on futures. So I got to cut it short, or not short. I've got to kind of met the time limit here. But I want to ask if there's any questions before I end the session. And like I said, we'll be back again in our next masterclass session, talking more about how to and the practical application of this.
Yeah, there's a couple slides that you had there that pretty much go into the practical aspects of this, right, Brandon?
Right. Oh yeah, we're gonna get into that. Yeah.
Okay,
Like
perfect.
sprints, yeah, strategy creation. Absolutely. We're doing that next.
So yeah, this is a great introduction to options, or futures options. So thank you for that, Brandon.
Mhm.
We look forward to next session where we're going to do some practical examples on Futures Plus and how you can build those option strategies on the platform. Um, so I don't see any questions in the chat. Do you, Brandon?
Not yet, no.
I
Either
guess
shy, asleep, or already I
it's a
answered
shy
everything.
group. Okay, so we are just gonna end it here, and the recording will be available in a couple or a few days. It has to go through editing and also compliance, so give us a few days before we post that to the masterclass archives. But again, Brandon, thank you for your time. Thank you for sharing your knowledge, and I look forward to seeing everyone in a future class. Oh, by the way, the next Futures Plus class is not scheduled yet. So we're still working out the November and December schedule. So look at the events calendar for lesson number 4 on this series. All right. Brandon, thank you again. And thank you, everyone. Talk to you later.